Hey guys, this is Nick from Financially Aware, and in this video I want to talk about bankruptcy and what happens to the stock of a company during bankruptcy. Now, a lot of people have been piling into Hertz as the stock has gone down, and now that they announced the bankruptcy, the stock is down like 80% since Friday or whatever, and a lot of people are thinking, should I dump it or should I double down, because they're in Chapter 11 bankruptcy, which is reorganization. So there's some hope that they're going to reorganize and continue operating. That's true, but that doesn't mean that you will still own the stock after they reorganize. So I'm going to talk a little bit about Chapter 7 and Chapter 11 and try to simplify what that means for you as a stockholder in these companies that filed bankruptcy. So Chapter 7 is liquidation, and this would be for a company that has no hope of continuing to operate. Something like Blockbuster Video, which was the big box video store that sold rented DVDs and videotapes and whatever. The market has changed. There's Netflix, there's streaming. So that business model is done. There's no saving that. So they would liquidate that in Chapter 7. Chapter 11 is something that has hope of continuing to operate, like maybe a gold mine or a silver mine or a copper mine, where the original owners took on too much debt in the good times, and then the price of gold dropped and they couldn't make the debt payments, and so the debt holders take over the mine and run it themselves profitably. So people think that this is going to happen with Hertz, that they're going to reorganize and the stock will eventually rebound and everything will be great. It doesn't really work that way. If you can't pay your debt, then you have no company. Okay, the debt holders own you. So the way it works is senior debt gets paid first. That's usually debt that's collateralized. In this case, Hertz is their senior debt is collateralized by the cars in their fleet. And then you have the unsecured debt, which are all kinds of loans and vendors and things like that. They're not secured by any kind of equipment or anything, but they're a creditor to Hertz. And then below that, you have the equity, the preferred stock, and then below that, the regular stock. So if the top senior debt holders don't get paid, then they could liquidate the whole company. So let me give you an actual example of how this works. This is the senior debt, let's say, okay? This is the unsecured debt, and this, the bottom, is the equity, the stock. So in normal times, when the money, the money they make flows to the top first, right? They have to pay the interest on the senior debt first. And once that is filled up, then it flows down to the unsecured debt, right? And once that's filled up and that's, satisfied, then any money flows down that's left for dividends or, retained cash in the company. So during the good times, there's plenty of liquid to fill all of these cups, even the big dividends and stuff. And this goes for dividend stocks as well. So the income that they have has to fill up their debt cups first before it trickles down to their dividend cups. So now what happens though in Chapter 11, what they say is the cup here says, hey, you owe me, let's say, $1 million a month in interest. And these cups say, hey, you owe me $500,000 a month in interest. And if the water coming in is less than $1.5 million a month, meaning not enough to fill the most senior cup and enough to fill the unsecured cups, then what they say is, okay, we're going to make some kind of deal where if there's enough, let's say there's enough to fill up the secured debt, $1 million, $1.2 million a month is coming in. So it fills up the top cup and only fills up, 1/5 of the bottom cups. So these bottom cups, the unsecured guys will make a deal and say, okay, look, this is what the company, the new or reorganized company, can support. You know, we'll close down some locations, we'll get smaller, we'll get rid of cars, and once we do that, it'll be generating 1.2 million a month. So it will fill up the most secure cup. It'll fill us up only 1/5 of the way, and for the other 4/5, we will issue new stock and we will own that company. So these unsecured guys say, okay, we will take the whole company now and own it and get our money that way. And so what happens is these old stockholders that are buying Hertz at $3 and $2.80 and 50 cents and whatever, thinking that there's going to be a rebound, what they don't realize is, yeah, there's going to be a rebound possibly as long as the airports open up and stuff, but the rebound's going to happen without you. The rebound is going to happen with the unsecured creditors getting the new stock, issuing new stock and owning all of that. Now some people are going to say, well, Carl Icahn owns 39%. He's not going to allow that to happen. He doesn't have much choice. It depends on what assets are available to satisfy all the debts. If the assets are not enough or not even nearly enough, then the stockholders are going to get nothing. If it's close, if there's a little left over, the stockholders might get something. So sometimes they might throw them a bone and say, okay, we'll give you 5% of the new company, which means that, the stock you had is only worth 1/20th of what it was before. That's if you're lucky. Usually it doesn't always work out that way. Usually the old stockholders get wiped up, they rip up that stock, come out with new stock, and the debt holders own the new company. So you may see this company trading and go, oh, wait a minute, that company went into reorg and came out and now it's booming. Yeah, it is. And the old debt holders are owning the stock. And so they reduced the debt that the company has and took stock for it. And so now the company doesn't have such a big debt load. So it's doing good. Their earnings are good because they don't have a big debt load because the debt holders traded their debt for stock. So that's what I want to talk to you about, these bankruptcy stocks. And so if you got burnt on the Hertz deal, learn from this, and because there's going to be a lot more bankruptcies coming out, believe me. So don't start buying into these cheap stocks just because they're cheap or they're in bankruptcy and you think they're going to come out and they're going to boom up and stuff like that. They could come out, they could boom up, but they're going to boom up without you because you won't be a stockholder anymore. And the people that do want to invest in the reorganization are the ones that buy the bonds of these companies. So if this unsecured debt here is bonds trading on the bond market, they are trading way below par value. Some of this Hertz debt recently was trading at 18 cents on the dollar, meaning the par value is 100 and this stuff is trading at 18. So it's 80% off. So what you could do, a lot of hedge funds do stuff like this, is they go up and buy a lot of this cheap debt before the bankruptcy is refinalized. And that's a way to own a piece of the stock of the new company when Hertz reorganizes and issues new stock. So that's how the hedge funds do it. They don't buy a whole bunch of Hertz stock of the old stock at 50 cents and hope everything goes, becomes better, because that's not the way it works. They go buy the bonds because the bond holders are the real owners of the company. That the equity holders own nothing if you owe more money than the company makes. So I hope you learned something in this video, and not to buy bankruptcy stocks ever, because it always turns out bad for the little guy because they don't understand the structure of how debt is superior to any kind of equity in a stock. So I hope you liked this video. If you did, give me a thumbs up, leave a comment, and let me know if you've sworn off of bankruptcy stocks now, or if I've convinced you from staying away from trying to double down on your position on Hertz or something like that. And as always, if you haven't subscribed, please subscribe. Thanks for watching.